Hello there, my friends. Welcome back to Silverfest. We're close to wrapping up day one, although how could you have day one of Silverfest without talking with Florian Grummes, aka Florian. Hello there, my friends. Welcome back to Silverfest. We're close Florian, to you may have another browser open that's playing Double Chris Silverfest without talking with Florian Grummes, aka Florian. Hello there, my friends. Welcome back to Silverfest. We may have another browser open that's playing Double Chris Silverfest without talking with Florian Grummes. Hello there, my friends. Welcome back to Silverfest. How are we looking there, sir? Florian? Are you able to hear me?
Now it should work. I'm sorry. Can you hear me?
Yes. Are you able to hear me, Florian?
Yeah, it was like double, triple. I don't know.
Okay. Yeah. Well, that's all right. But you can hear me okay now.
Yeah, it works. Good.
Okay. Well, welcome on into Silverfest, Florian Grummes Florzinho of Midas Touch Consulting, who's kind enough to join us today and provide the European perspective on silver. So, Florian, great to see you again. How are you doing?
Thanks, man. I'm pretty good, actually. It's all good. I really enjoyed the Silverfest so far. And yeah, thanks for having me. It's great.
Well, I'm glad to hear that. It's a darn pleasure to have you here. Really fun at our show a week ago. And perhaps dig in. I mean, what do Europeans think? I actually don't mention this often. I lived in Europe for a year and a half back in 2013 to 2014. My experience was that they're kind of trusting and believing American politicians and bankers a little more than is probably in their best interest. But what can you say? I mean, do they get it? Are there people talking about silver and gold in Europe, or what is the tone like there?
Well, I think it's as most of the time difficult to generalize. Certainly in Germany, I know that we have a very vibrant gold and silver scene. We have a few famous silver guys here as well who've been basically, recommending silver since the last 20 years. These guys wrote a few books and they have a large followership. So I cannot tell you too much about the other countries in Europe because I know the scenes are very small and it's just slowly starting. Also, there's a lot of restrictions and regulations where it's just not that easy to go to a dealer and buy some physical silver. So I know here in Germany, we have a lot of stores, we have a lot of online shops, we have a vibrant scene, people buying a lot of silver, but this is also connected to the German history, obviously. So I think, and that was my main point when we talk about the European perspective on silver, that most of the Germans, like myself, my family, like 2 generations, 3 generations ago, they experienced the hyperinflation, and it is still imprinted subconsciously in many families and many people. So Germans have been one of the strongest gold buyer nations over the last 20 years, and also silver, of course. But I know this is, I think it's similar in Austria and in Switzerland, but certainly not like this in France, and also not like this in Spain, and also not like this in Italy. So it's difficult to compare it. I think Germany definitely one of the largest gold buyer nations, and therefore also silver, quite a lot of demand here.
Yeah, and speaking of Germany, maybe we could do one non-silver question throughout the day here. Can you tell me what you were thinking when Germany asked for their gold back? I think it was 2013 or 2012, and the Fed said, we'll give you 10% over the next 7 years. Did anybody in Germany find that odd or cause for concern?
No, I mean, that was actually a big discussion here. And one of my friends, Peter Böhringer, he wrote a big book, Bring Our Gold Back Home, and he basically started this whole initiative. And he managed to bring it to the forefront in the yellow press, and that created a lot of pressure on the German central bank. And I think that's why they basically started this whole bring it back action. And yes, of course, everybody laughed about it when it got public that it would be so slow and just in small increments. But at least, well, it was a big step forward, because most of the German gold reserves at that point, back in time, they were not in the country. So it was a very big and important event, I think. And actually, it started also the chain of events that other central banks then started to ask for their gold and wanted to bring it home. So, and since then, I think that's one of the reasons where you could see that central banks all over the world started to shift their thinking, and now central banks are an essential part of the gold demand, right? So I think it was a very important event.
So Florian, I'm assuming that you don't recommend to your clients to store their gold and silver in one of the Federal Reserve's vaults. Is that correct?
For sure not.
I mean, you may as well put it in JP Morgan, increase your chances of success. Anyways, I see you have some slides down there, so
yep.
If you'd like to take it from here, I'm happy to give you the stage, and love to hear what you're thinking.
Thanks a lot. And yeah, cool. So I just quickly wanted to go to basically 2 points here. The first one is more like the fundamental big picture kind of analysis to make sure that everybody understands where we are. And the second thing is more like a technical point of view towards the next few weeks, maybe the next few months. And yeah, obviously, I only cook with water. I don't know the future. I ask you to do your own due diligence. And I want to start with the thesis that we are in a cracker boom, and that's basically the cracker boom is a word or a phrase coined by Ludwig von Mises, the famous guy from the Austrian School of Economics, and he basically wrote about it or phrased that term a few years before the German hyperinflation, more than 100 years ago. And I want you to first of all give you a quick definition about it. The cracker boom is an economic crisis that involves a recession in the real economy, which I think we have, and a collapse of the monetary system due to continual credit expansion, which is going on, and resulting unsustainable rapid price increases. I think that's what's probably still kind of missing, but we can also see it in some forms already. And the cracker boom is characterized by two key features. And the first one is excessively expansionary monetary policy that leads to out of control inflation expectations. And second, a resulting bout of hyperinflation, which ends in the abandonment of currency by market participants in a simultaneous recession or depression. And a cracker boom is the crash of the credit and the monetary system due to continual credit expansion and price increases that cannot be sustained long term. So, and that finally means in the face of excessive credit expansion, consumers' inflation expectations accelerate to the point that money becomes worthless and the economic system crashes. So that's the basic definition of cracker boom. And I strongly believe that we are in one because first, if you look at the balance sheet of the Fed, you can see it's going exponential and it's back above 7 trillion. The Fed balance sheet now represents 36% of the GDP of the United States of America, which is still low in comparison to the 135% of Japan. So there is still a lot of room for the Fed actually to go much, much higher here. And but it's not only the Fed, it's also the ECB. So the ECB actually is much more aggressive than the Fed over the last few weeks. Or not only weeks, over the last few months. So Madame Lagarde, the not elected French president of the ECB, she's printing 10 to 30 billion euros every week out of thin air. And the Euro zone, or the ECB balance sheet, now equals 61% of the GDP of the Eurozone. So they're still behind the Bank of Japan and also the Swiss National Bank. Coming in third, the ECB, the Fed is number fourth. So both of those central banks still have room to print much more in terms of percentage from the GDP. And both are basically parabolic already. This will continue. There's no end to it. And the consequences, of course, is, for example, the NASDAQ moving from 7,000 in mid of March to nearly 12, or a little bit above 12,000 recently, and now having a little dip, probably just releasing some hot air. I don't think we are seeing a big crash, but like Keith Newmar pointed out, yeah, in front of the US election, it could be maybe a few weeks, maybe 2 months of bit of a challenging time, getting rid of the super overbought setup. I wouldn't be surprised. But if you look, for example, at consumer prices, they jumped in August already. And that's what, if you remember the definition that I just showed you, is basically the only thing that's really missing. I know there is a lot of discussion about the velocity of money. Basically, that's the missing fact, some people say. But the European perspective on all this would be 100 years ago, after the First World War. In Germany, many shops were closed or destroyed. Many businesses were destroyed or closed. And there was a big strike due to the French reparation payments. And the German central bank started printing like crazy. And we have a rather similar setup 100 years later with the lockdown. So there is a very interesting component. And 100 years ago, this setup created the hyperinflation down the road. This was not a linear event. It was very volatile. It was in sharp moves up, and then you had even 50% corrections on the way higher. But 3 years later, Germany experienced the worst hyperinflation that mankind had seen so far. And I assume that we are in, and whether it will be 2 or 3 years or 5 years, or if it goes faster, it's a worldwide phenomenon, so it could take a bit longer. But this, I think, is the most important takeaway. We are in a cracker boom, and the do's and don'ts that I quickly want to give you here is, of course, you need to have a physical gold and silver position as your core position. It has to be physical. It has to be preferably in your own hands. An ETF, a mining company, a futures contract, an option, or a certificate or a warrant certainly is not that. Okay, you need to have physical gold and silver. And you also always want to be invested or stay invested during that cracker boom in gold and silver, meaning also you don't sell out of all your positions. Also, when it comes to the mining stocks, right, you need to have smart exit strategies and not sell everything. Sell maybe half of it if you see that one of your mining stocks went through the roof and made it maybe 100% or 200%, take half of it off the table, but don't sell everything. And also don't sell any ounce of gold and silver. Just hold them as long as you can through this cracker boom, because at the end, and you've seen this in the definition, there will be a currency reset in some form. And another thing is, and that's, I think, one of the big takeaways from the Silver Fest today, you want to overweight silver against gold. I don't need to get into the more details because Chris managed to bring so many good speakers together who explained that to you, but you want to overweight silver against gold, and you want to buy the dips, so you don't chase the strengths, but you wait for some pullbacks. Maybe they're not that deep and sharp as many people wish them to be, but there will be pullbacks and dips, and you need to simply wait if you want to add more to your positions. And also, one recommendation, own some Bitcoin. Figure out what that is and how you can invest, and just start with 20 or 50 bucks to figure it out. I think Bitcoin and silver are the dream team for the cracker boom. And don't short any market, please. I know this is tempting to short the stock markets, to short Tesla, etc. And yes, a few days ago it would have been right on, but you know that many months it would have been the wrong decision. So be very careful with shorting the market. I understand that the fundamentals all look dire and it doesn't make sense, but that's exactly the crack up boom. Okay, things I believe overall will move higher. Most of the stocks, most of real estate prices probably also will move higher, and you don't want to lose your money by shorting it. Okay. Another thing, don't hold currencies for too long. It's obvious, it's logical, but I would say a few weeks, maybe a few months, if you don't have a good idea where to invest, or if you wait for a pullback, it's okay. But everything longer than 3 to 6 months doesn't make sense anymore. At the same time, of course, don't let cash on your bank account make you impatient or stress you. There will always be opportunities, and yeah, markets will pull back, mining stocks will pull back, and silver also will at least slightly pull back at some point. So these are the do's and don'ts that I quickly put together. And I have some charts for you. This is the gold-silver ratio chart, the weekly chart. And we start here in May 2011. That was the top in silver, $50 back then, and the gold-silver ratio fell down to 32 roundabout. And then it took 9 years, and Corona, this ratio went up to 125, and silver went all the way down to 1160. So this is a 9-year bear market for silver, and the gold-silver ratio recovered strongly, actually shooted up to some of the highest levels we've ever seen. And the consequences of all this is that right now, you can see my little slow stochastic oscillator is flashing an extremely oversold setup. So it is very likely that the gold-silver ratio somehow will bounce at least a little bit from here. If we draw some more trend lines, you can see that this was a kind of a wedge, and the tricky silver price broke out to the upside for Corona, and then came back down. Actually went all the way to the typical classical Fibonacci retracement level, which sits at 61.8%, and this is it's round about 68 points in the gold-silver ratio, and that's exactly where where this ratio currently is stalling out a little bit, and that's where we are here. And if you look, we had kind of a support at those levels in 2016 and 17. It was a resistance in 2013 and 14, and it's been also a resistance in 2010. So I would assume that the gold-silver ratio has a strong support between 65 and 75, and it is very likely that we see some form of a consolidation, correction, or maybe even a pullback or a bounce from here. And if we use another time the Fibonacci levels, just to give us an idea where a market or a ratio could go, the gold-silver ratio went from 25 down to 68 something. And if it would bounce, the minimum, the absolute minimum bounce would take it back to 82. The normal minimum bounce in the bull market setup would mean probably 90. And if it just pulls back to one of those two numbers, it would actually signal extreme strength for silver, and meaning that the gold-silver ratio is in a very strong trend pro-silver. And if the ratio pulls back to those numbers, it still means that we're going to see some form of a correction in gold and silver. And one reason or one indication that this actually is probably already started is the silver ETF holdings. For the first time in a year, basically we've seen a big weekly decline in the ETF holdings, the biggest one since 1 year. So that's kind of a warning signal. And if we look at the silver daily chart, yeah, it's actually a mixed bag, similar in gold. Market could actually be right in front of a breakout to the upside, and that would be a very bullish thing. And it could also be more or less right in front of break down, and then everything would turn bearish. And usually when you have those kind of setups, markets just continue to move sideways. That's mostly or often the case. So silver is in a form of a consolidation or correction since the 7th of August. It's correcting on rather high levels. We had one first sharp pullback, but so far this has not really changed the trending picture. And you can see this is the daily chart. So the stochastic here looks pretty good. It looks like there is some room to the upside over the next few days and weeks. Actually, it's close to a new buy signal. And you can see that the 50-day moving average and also the 200-day moving average are nicely below the price, and they're both moving higher. You could make the argument that silver at least should maybe touch or meet the 50-day moving average before it's ready to move higher. But more important, I think, is the fact that we are in a new trend channel in silver. And you can see that this channel started in mid of March and reached a top in early August. And since then, it has moved back into the lower part of this trend channel. And normally, I would assume that it wants to test now the lower edge of this trend channel. So that would mean at some point, yeah, either if it would drop down right now, it would mean $23, $24. I don't see this right now. I think it's more likely that it will move sideways. I will show you why on the next chart. But just assuming it would correct in a normal fashion, the 38.2% retracement of this whole up move since the Corona crash would bring silver down to 22.90. If it corrects a bit stronger, the 61.8% would mean 1861 for silver, which is or looks rather low at the moment. It's actually $10 away from current price levels. So I'm not sure if the market really, or if the bears have really the power to move prices that low. I actually doubt it. I think if we see 23-ish, 90, yes, I think that's probably already the maximum. But more likely is that actually silver won't move much lower than $25 anymore. And you can see that here I have the Bollinger Bands. This is the blue shadow basically, and you can see that they're moving sideways. They're moving together. I guess we are seeing another Bollinger Band squeeze in the making. Something like this could probably happen here. And so in combination with this triangle, I assume that somewhere in October, November, probably you will have a final dip towards this trend channel. And then from there, silver should take off again. And I guess latest by next year in January, February, we're going to see prices above $30. That would be actually a realistic case. Because as Keith just pointed out, in front of the US election, I wouldn't be surprised to see some correction or challenges in the stock market. And as we've seen already, all markets are connected now. And the pullback in Tesla and NASDAQ in the last few days created immediately some pressure for Bitcoin, for example, and also for gold and silver. So if the stock market faces some more challenges over the next few weeks, I guess gold and silver are not ready yet to march higher. So I recommend to remain patient and also remember that basically always before the largest up waves, there is one pullback that shakes out the weak hands. And we've seen this year in June and July, when gold basically looked like ready to break out above 1750 and then final pullback to 1670. And that was the pullback that basically took off most of the weak hands. And from there, the rally towards the new all-time high started, and gold gained $400 in 2 months. So these little final shakeoffs, pullbacks are typical and to be expected. And obviously silver would probably at least see its 50-day moving average at some point and probably pull back to this lower edge of the trend channel. So that's my main expectation. Right now, I'm a bit patient. I'm waiting for a good low-risk opportunity. And yeah, that's basically my my presentation for today. If you want to follow me, this is our website, Midas Touch Consulting.com, and we also have a Telegram channel where we have basically daily signals also for gold and especially for silver. We have a weekly silver chart book where we have, I think, really good, helpful, principle-based material that helps you to become more successful with your trading and investing. And that's basically my presentation.
Well, I sure appreciate that. And perhaps one last fun one before we wrap up. One of the things I like for my trading days, you could always ask someone market on something. So if I said, what is a price that I could trade on, bid in an offer, make it a little wide if you want, but 5 years from today when we're at Silverfest 2025, give me the market that for a silver price.
5 years from that, well, I think we're definitely triple digits. I think that's for sure.
That's good enough. I'll let that suffice. I think you're likely right. I mean, it's outside of the fact that the American banks do some shady stuff. It's even with the manipulation, it's harder for me to construct how it's not triple digits 5 years from now, given what these central banks are doing, as you pointed out. So, Florian, I sure appreciate you checking in. I know it's a little bit later your time. If tonight or tomorrow you're interested in taking questions, you're welcome to hop into the Arcadia Lounge. And if you do, let me know and I'll make an announcement. I'm sure there's a lot of people who would like to talk with you. And again, just appreciate you joining us here today at Silverfest. Great presentation.
Thank you very much. Yeah, sure. I can do it now, actually.
Okay, great. Well, when we log out in a second, you can let Yara know, and she'll set you up in the Arcadia Lounge. So thank you, Florian. And coming up next, we have another presentation from John Lee of Silver Elephant. He's going to be talking about some of the factors going into 2021 and then taking some questions. And again, if you'd like to talk more with Florian, that's going down in the Arcadia Lounge. So with that said, we're going to wrap this segment up for now. And Florian Grummes, a.k.a. Florzinho, thank you again, sir. It was wonderful.
Thank you.